Hey, welcome to another exciting week on Fish Innovation Podcast. Today, I have a very special guest that is a founder and CEO of a financial services company. We're going to get a little bit deeper into that in just a second. But what he's solving for is what we all want to have happen for us today. I don't want to give away too much because I want to give the honors to him, but he is internationally known, comes overseas almost all the time because what he has to offer, everybody in the US wants it and needs it, and they want him. So, with that, I want to introduce Jonathan Arad to the show. Jonathan, how's it going?
It's going well, Ben. It's going well. Thank you for that, and thanks for having me.
I'm glad you could make it. I know you're a really, really busy guy. I really appreciate it that you're taking the time. We're even talking pretty much in the middle of the night, your time, and you got to get up for an early flight. So that I feel extremely honored that I get to talk. And I know that our listeners will be really honored to hear what you have to say. First, it's the same question I always ask everybody is talk to me on what was the journey that led you to Takara?
So again, thanks for having me. I'm excited to share and to do it here with you guys. So my formal education is water distribution system engineering. I'm a water engineer, and I spent many years trying to identify blockages and clogs in water distribution networks and designing solutions that restore water flow. My wife called me a glorified plumber, a plumber with a master's degree. And I have to say that ironically, I find myself doing the same thing, only on a very different kind of network, but trying to unclog the US mortgage slash real estate market. But there are a lot of similarities. So I started my career as a water distribution systems engineer, and I transitioned to capital markets about 2 decades ago. And I've been working in the intersection of finance and innovation and technology for about 15 years. Started in the insurtech space and then into capital markets, traded short-term interest rate futures for a while. So I have a lot of finance background. And in the past 5 years, I've been working and dedicated my work to the US mortgage market and innovating in financial markets and with financial models in order to solve what we think is one of the biggest problems today. It is a finance problem, but it is in fact a real life problem. One of the things that I always say is that there's a saying: "What connects Wall Street to Main Street is the mortgage." So trying to
Yep.
solve a mortgage finance problem is probably something that most affects people's life and their quality of life, and that's what we're doing.
Yeah, I 100% agree. And I love that story. I mean, I love, the not just the clogging, you're unclogging the mortgage system. But I think I want to point out to our listeners, we have a similar background in the fact that we were both kind of scientists, engineers, and then kind of moved into the financial space. And I know a question I always got from folks was, whoa, how did you go from science to banking? It seems strange, right? And it's a question, and I'm sure people might even ask you that, like, oh, you were a water distribution engineer. Like, how did you find yourself in capital markets? And I'm not going to ask that to you because I know what that question feels like. But for those that are wondering, right, like how is that possible? It's probably the best combination somebody could ever have in financial services is being able to have that scientific method background, that problem solving process and methodology that we all go through as scientists actually adapts really well to financial services. Doesn't seem like it should, but it does. We could spend probably 3 hours talking about it in a whole another podcast show going into the workings of it. But what I want to point out is what you do is really unique and your ability to problem solve. So coming up with the solutions like you have with Takara clearly had a lot of thought behind it and really understood not just the pain point, but like really how to efficiently, effectively, and elegantly solve this problem. So I think, I want to hear more about what the actual problem is. Like, I mean, there's a lot in the mortgage. We could talk about secondary mortgage. We could talk about, the connection between Wall Street, but what was the problem that you initially were solving when you came up with Takara? And is it the same problem you're still solving for today? And, or how has that changed?
Absolutely. But before I answer that, I want to reiterate what you said, and I completely agree. I think engineering background is so relevant in finance, just for the reasons that you said. But let me add just one more, and forgive my language. There's no time for bullshit in engineering. You have to have a bullshit radar to know, okay, this is just nonsense, or this is not founded, this is just hot air. And you see a lot of that in finance. In many cases, you see entire companies built on marketing without real solutions, sometimes even without a problem. So I think, and you call it problem solving, but it is critical thinking, being very logical in how you dissect the problem, and being right to the point when you try and find a solution. In any case, back to our topic. So there were millions and millions of Americans and American families who took advantage of the ultra low rates of the COVID era. So people in 2020 and 2021 who took out 2.5 and 3% mortgage rates, 30-year fixed, and they were extremely happy doing so, and they should be. And the banks and credit unions that gave them those loans were extremely happy. Origination volumes were never higher.
Yeah.
So
I
everybody was
refinanced.
exactly, there was a refi boom. We're talking about $16 trillion worth of mortgages below 4%. So huge amount, like astronomical values. Nobody thought, but reality happened. And if you fast forward a year and a half, rates jumped by over 500 basis points.
Yeah.
I see you're laughing. My
No,
guess is
I
that,
know it. I know.
yeah, exactly. And that's the pain that almost every family in the US feels one way or another. And the point is that people with a 3% loan will never leave their house unless they have. They are going to hang on to that mortgage to their dear life. They write, it's probably the best financial asset they will ever own in their lifetime.
Yeah,
So
you're right, because if you sell your home, you're not going to go live on the street, right? You're either going to have to downgrade. So that's fine if you're, older generation, baby boomer or something. But if you're like, my family's expanding, I'd love to have a bigger place, but I know I'm going to have to get that rate. You're going to have to get a lesser home for more just because of the loan, unless you somehow find the cash, right, to buy it.
you're absolutely right. The same quality of life has now become significantly more expensive. Now, the point is, if you like your home, you're in the perfect position. The problem starts when you want to move or you need to move. And that's where it gets interesting, because there are a lot of people in a lot of families who need to move for a variety of reasons. Life happens. I remember when my third daughter was born, my wife and I very quickly understood we need a second bathroom. One is just not enough. So we
Yeah.
wanted to move. I mean, so if I had a 3% mortgage and moving means I'm going to take a 7% mortgage, I would be at a problem. And that's the problem that many millions of Americans find themselves in. It's the terminology is the mortgage lock-in. It's also called the golden handcuffs, the rent control of home ownership, all sorts of.
Yeah.
I mean, that low rate was great until it isn't. And I'm not even talking about missing out on work opportunities because you can't relocate. Now, the other side of this problem are financial institutions who have these assets, these loans on their balance sheet. So they are locked in just like the borrower with a 3%
Yeah.
return on a 7% environment. So they have a losing asset that is never going to be paid off. And that's why the entire mortgage market is basically frozen. And let me quantify that. On normal operating conditions, around 15% of mortgages prepay per year. Those are people who are moving and paying off their loans, just living out their life. Those prepayment rates today are at around 2 to 3%. So every single person who doesn't have to move doesn't. So
Yeah.
the entire mortgage market is stuck, and that means real estate is stuck because inventory doesn't change, existing homes are not in the market, asset prices go up, everything is just at a standstill. So that's the clog in the system that we want to solve.
Yeah. So how are you solving for it? I mean, I
Yeah.
think we all want to know how Takara works and what's the benefit to the buyer and what's the benefit to the lender.
Yeah. So it might surprise you that our solution is a win-win for both the
Yeah.
financial institution as well as the lender, because that's very uncommon in finance, banking, and especially in consumer lending. But before I tell you how we do it, let me tell you a story. So this problem that I just described is very well known and well documented. Even if people don't know it by name, they feel it in one way, shape, or form. But
Yeah.
what people rarely know is that this is an American problem. It doesn't exist outside the US. Nowhere else in the world people have this problem. And I always give an example of the Danish mortgage market in Denmark. And the
Yeah.
reason why this mortgage market is relevant is because the 30-year fixed rate mortgage is also the most popular product in Denmark. So you would expect them to have the exact same issue,
Yeah.
but they don't. And the reason why they don't is because even though the product is similar, the system is different. When a Danish mortgage is originated, it is covered by a single bond, which is then sold and traded in the open market. So no securitization, one loan, one bond. And if you're a Danish borrower and you want to pay off your debt, your loan, you have two options. The first, you can prepay the outstanding principal amount, just like here in the US. The
Yeah.
second option, you can buy the bond in the open market.
Interesting. Okay.
So what does that mean? If rates
Yeah.
go down, I refinance to capitalize on that benefit.
Yeah.
When rates go up, what happens to bond prices? They go
They
down. So a Danish borrower, when rates go up, they buy their bond at a discount because the price of the bond goes down below the outstanding principal amount. In 2023, when rates spiked in Denmark, Danish borrower paid 80 cents on the dollar and prepayment rates tripled to 30%. But the market remained active and liquid,
yeah.
and they don't know what the mortgage lock-in even means. So what we did, in fact, in Takara, is we identified the best-in-class features and solution in mortgage markets around the world to offer this benefit to American borrowers. And what is that benefit? So we are working with banks in the US and enable them to offer a discount to exit a low rate mortgage without the bank writing a loss.
So
So
you're
if you have a 500K loan at 3%, you will all of a sudden get a call from the bank. Listen, Ben, you can pay me 425 and exit your loan. No questions asked, no fine print, no small letters. 425, a 15% discount. Or that is a $75,000 benefit that you get immediately.
what but where do I get the 425,000 from?
So how do people pay off their loans? How do people pay off mortgages? And again, going back to the problem, this allows them to move. So they sell their property, and instead of paying back 500, they pay back 425, and they are left with $1,000 pile of cash on their table, which they use in order to increase their down payment for the new home or a smaller purchase loan, or I don't know, pay off their credit card debt, whatever they want. But traditionally, the source of capital when a borrower pays off their mortgage is the proceeds of the sale of the property.
Yeah, but let's say I didn't want to sell my home, right? I wanted to take advantage of this because I mean, let's say it was a bond as a solution. I can say, great, rates are high. The bank will give me a discount. I'll buy a bond. They'll take a fee, a transaction fee or something, right? So they're making money on the transaction. And then now from my perspective as a borrower, I'm roughly paying the same amount of cash each month to be in my house, but I know that I'm paying it off faster, or I'm paying less each month, than I wanted to. And it's sort of like refinancing without having to pay for the refinancing costs, because that's expensive too, right? Because when you go back and forth, you only want to refinance if it makes sense economically. So how could
So
somebody do this without selling their home?
Excellent, excellent. So basically, you don't have to sell your property. I mean, there are traditionally people pay off their mortgages by selling their property or by refinancing. So that's the
Yeah.
same case here. You can use your savings, you can take a refi or a cash out refi loan, you can sell your property, maybe you're liquid, maybe your parents gave you a gift. I mean, basically we don't know, we don't
Like,
care.
yeah.
What?
We should be so lucky, right? Our parents are giving us money.
Well, yeah, I mean, it's out there. I mean, there are those people somewhere, but that's definitely not the majority of people. But basically, you can do those things. So again, the benefit is the same. You are getting an exit discount. You can pay off your debt and be completely released. No fine print. The house is released from the lien is released from the property
Yeah.
with around 15% benefit. A 15% is in relation to a 3% 2021 loan. If you have a 2.5%, it would be closer to 20% discount.
Yeah. So you're kind of creating cash incentives to pay off your loan quicker. Let me give you this use case because you mentioned folks they have to move, right? You're like, hey, I got to get into this new house. So some people might say, look, if I have a 3% or 2.5% mortgage, my rate, my monthly fee or cost is not that much. I can rent for twice that amount. Why would I want to sell off my mortgage when I can go rent? Now I know there's other complications and things like that, but let's just say a person is making $300 a month in profit by renting their house. And then that helps pay down their new mortgage with the higher rate. How would Takara, your solution, make it a better decision for someone to say, I'm going to go get Takara because now either I don't have to rent and I can sell my home and I'll get cash to then go get the house I want, or like talk to me. I'm interested in hearing how you would solve that piece where somebody can still get the same low rate on the new home they buy.
So I think that's a great point. What you're talking about is the psychological play. I mean, people have to transition from being a homeowner to a tenant. And economically, you're right. So economically, in this environment, in many cases, it's better to be a renter than an owner. And it's better to rent your primary residence and move, even though real estate prices went up and blah, 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 and you need to find the security payment and all that. But let's assume that you have
Yeah.
that. It is very a niche audience that are willing to do that transition after you're a homeowner. Traditionally, it's the other way around. Traditionally, people are moving from being renters and tenants to becoming homeowners, and not the other
Yeah.
way around. What
Well,
we see
or
in the
even a
market,
homeowner to a homeowner, right? Let's
exactly.
say you're
Once
like,
you're a
okay,
homeowner,
yeah, you get a new job, right? You got to move let's say you're moving from North Carolina where the home prices are lower and you got to move to Connecticut and the home prices are higher, right? So you're like, okay, I'm already not going to get the same home and my rates are up there. But I do want to own a home. So how could Takara help like that person? Could Takara help them actually make the decision? Should they rent or should they sell and why, right?
so absolutely. I mean, if you look at it from I mean, it's basically all counting dollars, right? If you were to rent, you would get a house that you can afford with the cash flow that you have. If you were to move, what we provide you, what the car solution provides you, is an extra 15% capital, 15 out of the outstanding principal, which means that you can buy a much bigger home relative to the home that you're currently in. So let's say I have a 500K outstanding principal loan at 3%, and let's say my home worth is 600. Okay. And I want to move to relocate. So I'm not upgrading or downgrading. So I want to buy the same value home, 600, right? In normal operating conditions, I would have to sell my home, pay back 500, put the down payment of 100, take 500 at 7%. My monthly payment doubles, if not triples. I can't afford it. With
Yeah.
Takara, I sell my home and I'm paying back 425. So now I have 175. First of all, I can buy a bigger home. Second of all, I can take a much smaller loan, which will decrease my monthly payment significantly, which would
Yeah.
free up my cash flow capital, which is probably the most important nowadays, right?
Yeah.
So someone once told me many years ago, cash flow is king. I
Yeah.
mean, people look. I mean, savings is probably one of the most important concepts in finance, but people look at cash flow as the most important element of their day to day, and we allow you to improve your cash flow significantly by, in a way, cashing out on the benefit that you locked 3 years
Yeah.
ago. Like having a 3% loan at a 7% environment is worth something. So why can't we give it to the borrower? Why do bank? I mean, if a bank, let's say you're a bank and you had a 3% loan on your balance sheet, and let's say you were forced to sell that mortgage in capital markets for whatever reason, how much are you going to get for that loan? You're going to
Yeah.
get 80 cents on the dollar
Yeah.
because that's what a 3% asset is worth at a 7% environment.
Yeah.
So there's no question that those mortgages are worth 80 cents on the dollar. So why can't the borrower buy them at 80 cents on the dollar? That's what they do in Denmark. So
Yeah.
that's what we allow them to do. In essence, we are liquidating that 20 cents and we give most of it to the borrower and they can do whatever they want with it.
Interesting. So first up, you're basically in, like, let's just look at the economic conditions today, right? You got situations like home prices are high, rates are high. We're hoping they're coming down. So they might have gone and sold their home to start renting. Now they're paying twice probably what they would be normally paying it as a mortgage, which means that asset you just sold is decreasing faster than you wanted it to. And so you're basically saying, hey, you don't even need to go start renting. You can move into another home because I'm essentially nullifying that increase in interest. And then how the sausage is made is you're basically saying, well, now you're really owning a bond type situation. So later on, long term, when rates go down, you have the opportunity to then refinance, which means you could lower your existing payment, which is already pretty low to start, on a house that you wanted to buy, even lower. So therefore, forget the whole rental thing. Just go buy another house, which is, again, like you said, it's a win-win-win because the homeowner or the borrower gets a new home to go into, which is what they want. The bank gets a new loan on their books, on their balance sheet that is much higher, which means they can put it on the secondary market and all other stuff for much more. And then it's a win-win. So my only question though is, I feel like Takara loses in this because Takara's, I would think, is fronting the bill on this, right, to do it. So how does Takara come out a winner in this at all, right? I mean, I love the philanthropic aspect and the benevolence coming from you, but I mean, after all, you're a business. I don't want to be rude asking that question. I'm like,
No, I
it
mean,
seems really nice for you guys, but how are you gonna? How is that sustainable for you guys?
when I raised capital for the company, I said I told the story just like I told here. I mean, it's a
Yeah,
huge problem, a huge market. It's a win-win solution. But the bottom line is, okay, how much money are you going to make? I mean, why do you want to take my money? How much money are you going to give me? What's the ROI on Takara?
yeah,
So it's not a rude question. It's a business question, and it's an extremely valid question, especially in banking, because traditionally it's a sum zero game. If the borrower is making money, the lender is losing, and vice versa. So if
yeah.
I'm telling a story of a win-win, it sounds weird, especially if Takar is also making money. But that's the case here, and it is based on the following concept. There is a huge disparity between the face value, the outstanding principal amount, and the value of the mortgage in the open market. Let's say that difference is 20 cents on the dollar. So the mortgage is worth 80 cents on the dollar. It means that there's 20 cents on the dollars that is the difference. What Takara is doing, we are allowing the borrower to enjoy around 15 cents out of that 20. So
Okay,
80%.
yeah,
And
that's
the
fair.
rest, the five, that's our fee.
Okay, yeah, and that, I mean, you should. I mean, obviously, because you're offering a service that nobody could do unless your IP exists. I mean, that's good to know. I mean, I'm glad. I mean, I people will be like, sure. I mean, 15 is better than zero, and that's amazing. Like, so that's
You
such
know, it's such a great point that you just raised. When you said 15 is better than zero, we looked at we have a lot of data. The take rate of 5% discount is higher than 10, and 10% is higher than 15 even. And it was shocking to me.
yeah,
But then we talked to the borrowers and we talked to the loan officers, and they
yeah,
told us that when you offer someone 5%, the alternative is zero. So to them, it's a great deal. A 5% discount in the mortgage, 500 basis points in a mortgage, that's unheard of. 10% already sounds a bit too good to be true. So people are more
yeah,
hesitant.
exactly, yeah,
And 15% sounds like okay, there's a catch here somewhere.
exactly, yeah.
So it's almost counterintuitive.
Yeah, I know. I saw the same example when I worked at B of A long time ago. They were having such trouble with the preferred rewards platform because people were like, this is too good to be true. And everybody had to explain, like, I know, but it's a great program. And we want to reward people for bringing over their assets. And they're like, but you already have these assets here. You're giving me this. Like, well, yeah, because we want to reward you. No other bank is doing that. And so it's really hard for people to understand that. So when I was shocked too, and I was like, I'm sorry, what? It's free money. You're what? You're questioning this? Like, I get it. That's okay. Yeah, that's fair. I mean, you want to do your due diligence. And I love that. So you're just making it very clear, like, hey, something is better than nothing, but it now makes sense in contrast because you're like, all right, not only are you giving me the ability to get it on 80 cents for the dollar, but then I'm also getting an additional 15 cents on top of that to help me pay it down, which is awesome. So it's like a risk-free loan almost that you're giving me to help pay down. So at the end of the day, if I'm thinking about the borrower in this case, they're going to get confused by all the math, right? They're not a banker. So they're like, all right, if I partner with Takara, I sign up with them and I do what I want to do, I know that I'm going to be able to basically pay the mortgage I'm paying today on my existing house, get a house of similar value. Understandably, I'm in Connecticut. We're going back to this North Carolina to Connecticut move. You're like, look, I'm not going to get the exact same square footage and stuff, but a home that costs the same, I'm not paying any more than I have to because I could do that. But if I wanted to get a little bit better home, yeah, my price goes up, but I still don't have to worry about going, oh my God, on top of that is the fee. I'm getting a low interest. It's like if I wanted to, it's like I could go in the past, get in a time machine and buy that home 4 years ago, right? But it doesn't exist. So you built a time machine, Jonathan. That's amazing. I love that. Like, so that's,
A
you
financial
did the
a
entire,
financial time machine.
yes, like that is brilliant. I mean, I know if you're watching the YouTube, you're seeing my excitement. This is authentic excitement. This is groundbreaking. I mean, you have created something that, yeah, we can say the system's broken or whatever it is, but you created something that literally puts money in the pockets of the borrower and the bank. So the bank is more than happy to do this, which is a tough thing, and everybody wins. Now, somebody on here who's listening is going, there has to be a loser here. Okay. There's a loser somewhere. And maybe I'm wrong on this, but I'm kind of thinking it's the Wall Street guy. Am I wrong in that? Or I mean, this is Newtonian physics. Right? For every reaction, there's an opposite and equal reaction. Energy is conserved, right? We could probably say that about the financial landscape as well. We know that the money is going somewhere, so someone's not getting that money on that. So do we see a hit in the secondary market? Like, where is the downside in this, and who's taking the brunt of that? And it's okay if it's a Wall Street guy, right? I mean,
No, no.
that's
I
probably okay.
I mean, it's. I was a Wall Street guy.
Yeah.
I traded interest rate futures between 2007 2009. So I was there at a very interesting point in time in the economy.
Yes, that's
Wasn't my fault. Wasn't my fault.
Yeah, no, no.
I was the other side of that trade. But in any case, what you have just asked is exactly the manifestation of this can't be a win-win. Someone has to lose. And I'm afraid I don't have an answer because there isn't one. Nobody is losing. And in this transaction that we are executing, what we have found, and that's why we call the company Takara. Takara is treasure in Japanese. We have found a treasure. We haven't taken it from someone. It was there. It was created because of the rate cycle. Now, the locked gain is at the borrower side. So borrowers have a locked gain. It's in the walls of their home. What we have found a way is to liquidate it. That's it. And we are giving 80% of it to the borrower, and the rest of it goes to us and our partners, and that's our business model. And by the way, importantly, we are working with banks and credit unions. So we are a B2B company.
Yeah,
And the banks are the one who are in fact marketing our solution to their borrowers because their
yeah,
relationship with their clients is probably one of their most important asset, and we don't want to intervene with that. But
yeah. I mean,
yeah,
well, even, I mean, yeah, if I was a consumer, I'd go on the Takara website and be like, who are the banks you're partnering with? Because I'm just going to go get my loan with them, right? I'm just going to reach out to them and be like, hi, I would like to get a mortgage with you. I'm looking at this home. Can you pre-qualify me? Because I'm just going to get my mortgage with you. And let's call that a done deal. And now it's like, hold on, inbound leads to banks? I'm sorry. What? How did that happen? Like, that is now again another like added benefit to what you're creating. Like, so going back to it, I mean, again, I know we want to call them losers, right? We don't want to feel bad. Maybe somebody's out there. I was just trying to say, hey, if the consumer is winning, the banks are winning, maybe that consumer out there might be like, well, someone's got to lose. But in essence, what you've done is you've created a bigger pie. And I think that's where I think when we talk about innovation, that is like the true definition. It's not like maybe some people might say, oh, it's a faster way to do something and more efficient. No, you've taken probably like the best example of innovation, which is you've built a bigger pie that everybody can take from now. Instead of, changing the slice size, which is what a lot happens today with these rate changes and everything, there is a winner and a loser. Someone gets a bigger piece of the pie and someone gets a smaller. But if we think about the pie going bigger, we all get the same slice. It's just that we get more out of that slice now. So if you're hungry, you get it. So you've created something that it's very rare. Like I don't want to call this an anomaly because it's very rare for someone to come up with a solution, a product, a service, you name it, that makes the pie bigger in such a manner that gets everybody to win. I mean, if I owned a bank, I'd be like, I'm just going to open up a mortgage bank and partner with Takara. Like, I don't even need to worry about anything else, right? I mean, obviously, I need to worry. I need to get some receivables in there, but like, I could boost my mortgage business in a down time. Like, whoop, like I reverse it.
you
I
can
mean,
you can turn
it's
your low rate portfolio into an engine of growth.
but I can make it a consistent. Like, so we know mortgage business ebbs and flows, right? There are people on here who are going to listen who are from banks who work at all major banks because within my network, they're all at banks, right? So they're going to hear this and go, whoa, the biggest pain point I've got as a bank in my mortgage business is it goes up and down, up and down, up and down. And I throw resources when the rates are good. I throw resources to do refi and first purchase. And then when they go up, I go, oh, I got to reallocate those resources. So my ROI ends up taking a hit. So I have to look at it in short bursts and short-term thinking. You've enabled me as a bank to literally have a long-term strategy for my mortgage business, which brings in consistent cash flow. And regardless of cycle, it's cycle independent, which is going to have me compete dramatically with anybody else. It's mind blowing. Like I can take on more deposits because I'm going to go do more lending, right? It's sorry. This is the excitement is, oh my gosh, right?
You are
Like,
you are spot on. You are spot on. What we have created, what we have built in a way for banks, it's an infrastructure play. It is a way to be agnostic to the rate environment. Because when rates go down, they have the refinance tool. And when rates go up, they are stuck. Now they are unstuck. And they
Yeah.
don't care if rates go down, they refinance. And if rates go up, they offer Dream, which is our program. And they make money both ways.
Yeah. I mean, you could, I mean, I'm just thinking like, so let's just take the average homeowner. Okay. You created a multifaceted benefit for someone who owns a home because you could say, all right, let's just say I'm going to stay in my same neighborhood. Okay. I could choose to move. Okay. Right. Average home, I think it's 7 years. Somebody lives in it. If I remember my mortgage pricing days, I don't,
Yeah,
maybe that's changed a little bit,
absolutely.
but I could, I could move to a different house. No, I get it. There's the pain of moving and all that and stuff like that. But if I were to run some calculations, I could essentially use my home as a vehicle to make investments to grow my generational wealth, which we know is a big Gen Z and millennial. It's a desire. They want to create generational wealth. So there's a lot of folks out there, startups today, like, how do I create generational wealth? You could, I'm not saying you would, and I'm not trying to go out the scope of it, but if somebody wanted to, again, the money's theirs, they do it what they want. They could buy the same home, doesn't matter the rate environment, get the same mortgage. Have it just the walls are different and the interior is different. But now they have an extra free money that they could go and invest in. Now, yeah, that's a big leap, right? Like to get $75,000 on your $500,000 home to go invest is a lot. However, if you were to go to the bank and say, well, I want to go buy, $200,000 worth, you've got some equity and skin in the game, your LTV changes, and they go, I might give you a personal loan because I know you've got this 75 grand that's coming to you because you sold your home. We've just booked you for another mortgage. So we're happy to keep you on books. As long as you stayed with us, we're more than happy to give you all that money back. And we're going to give you a bigger loan. So now you could go invest. So if you were a landlord and you owned a bunch of property, you could literally buy and sell property to liquidate to grow generational wealth in a different market. That
Now,
is
now
the
you're
American
moving.
dream. What?
I think now we're moving from the tactics to the strategy. Our mission at Takara is not short term. It's home ownership affordability at scale. It's taking
Yeah.
the home ownership rate from 65 to over 70. To do that, it's not about automation. It's not about a better pricing engine. Those are important, but those will not make macroeconomic changes to the big things that make life different. You need structural changes, different models, innovation at the system level. And that's what we're doing. And we have spent about a year and a half to take those in-class solutions from abroad and to adapt them to the US market and regulatory environment. So it would not take a decade to introduce these solutions to the market, but months. To me, if someone asks me what's innovative about Takara, it's not the concept.
Yeah.
Because they will tell me, oh, but it's in Denmark. And they are right. Takara's innovation is finding how to adapt those best in class features and solutions so they can be introduced to the US framework banking system in a matter of months and not years and decades without legislation, without regulatory changes, without, I don't know, tax rulings, all sorts of painful things for young fintech companies.
Yeah. I mean, of course, like I love it. I'm just thinking like from the borrower perspective and the bank perspective, I'm putting on both those hats and I'm like, you know, take my money, Jonathan. Not only do I want to work with you, I want to invest in you. I mean, this is amazing. Where Talk to me about like the sustainability of this, right? I mean, I get it because if we know, assuming the stock market stays alive, and the bond market exists, and I'm just asking this question, right? Like people talk about recession, they talk about, you know, we know bonds don't because they're the first to get paid off, so that's I think people need to understand that all because the stock market crashes doesn't mean their bond is going away as well. The rating might change a little bit, but talk to me like, let's just say the country goes to crap and I lose my job. I need to sell my house because I need to downgrade. I need to move to go take a new job, or I need to save money. So traditionally, I would just try to sell my house. I'm going to take whatever I get for it. I'd go rent. I put money in the bank. Is like Takara recession proof? If everything goes horribly, I could say it's in my benefit to go get a loan or work with a bank that provides Takara as a solution, because no matter what happens in the rest of the world at any time for the next 100 years, I'm okay. Is that a true statement that I could say, or what am I missing, or how would you modify that statement?
So on so we have two sides of the transaction. You have the borrower side and you have the lender side. The borrower side is there's in our case 15% better off. If there's a recession, maybe they will feel that pain, but they will feel it $75,000 less, but they would feel it. The lender side is significantly improved because what we allow the lender to do is replace the credit risk of the borrower with
Mm-hmm.
the credit risk of the United States government. Now, one might say
That's
that that's not a good trade, but from a regulatory perspective and from the banking system perspective, that's taking the risk to zero. So I'm not saying zero, just like the regulatory definition is
yeah,
essentially risk free. So
yeah.
we
We
are
we have
improving
bigger problems. If the
exactly.
government, I mean, if the government collapses as a country as a whole, we have way bigger problems to worry about than that, right? So
We are
that's
dramatically improving the risk profile of their balance sheet. So it is an unparalleled upgrade to the collateral from a property to a risk-free security. And by the way, it has a ripple effect of benefits because the risk weight is significantly lower. So the equity is released. Those are liquid securities and they are priced in market. So it's much easier to know what's the value of the collateral. It is a landslide improvement for the financial institution. And by the way, I'm not even talking about the diversification of the concentration risk, because once you take the borrower, take for example a regional bank.
yeah,
They are extremely exposed to correlation between their borrowers. So if you have a recession which is concentrated on a certain geography, if you have a regional bank, they have a huge concentration of risk on those borrowers. We replace that. So we remove that credit risk and the correlation between the borrowers by taking the borrower out of the picture and replacing the collateral from the property to a risk-free security. So
that's
bottom line, we are counter-cyclical. So
yeah,
when things are great and rates go down, people will refinance. Currently, it's the other way around. I don't know for how long rates are going to be the way they are, probably for the foreseeable future. We are not in the prediction estimation world. That's not our profession. But as long as the 30-year fixed rate mortgage is above 4%, our business is thriving.
yeah. I mean, it's and I get that. None of us have a crystal ball, but you're hedging your bets, right, with on both sides, right? So again, yeah, you're right. They feel the pain, and I agree with that, but it's 75,000 less, right, or whatever that might be on their home. And hey, in that case, something is better than nothing. Again, right? And
Exactly.
you also have the ability to bounce back from that too. That's the nice part, is like you're going to, and again, we're all cyclical, so things will happen. So it's just, we talk about this, it's one less worry to have. So it's almost like peace of mind, I should go. And then when you talk about the regional bank and the risk, I mean, if I was a regional bank, I should be lining up at your door, pounding it, trying to get in to be like, let's partner, because I'm going to, as a regional bank, outdo some of my national competitors and I'm going to do it without the risk profile that I have today, much lower risk profile. And it's like, this is a no brainer. I don't know. I'm not there in their conversations, but Me with my background, I'm going, why not? Why are we not? I'm sure there's always a reason, but this is really beneficial, and there's drive on both sides. I mean, the marketing sells itself, right? Like it's not a right it's like, you want money? Sure, I want money. Oh, great, let's go do it, right? My bank's giving me money to
And
get
we're
a
not
loan.
even talking about the customer experience.
Yeah,
And
well, I am because I'm a product
that
manager.
that no, but think about from a retention, getting a call from your bank and they're
Yeah,
giving you money. When
yeah.
was
You're
the
like,
last
what's
time
the
that
catch? You're like,
happened?
no catch. We've looked in our records, and it turns out there's an opportunity for us to give you 15 grand. If you don't want it, I understand. But if you'd like it, we can put it as a statement credit and go ahead. Well, what's the catch? Well, the catch is you're going to get a new rate, but you're not paying any different. Nothing's changing on your side. But this is the why it's happening. Oh, okay. So how can you do this? Well, we partner with a company called Takara that enables this, and we think it's important that we care about our customers, our consumers, and we want to give back. Just like other banks give dividends to their stockholders, we focus on, as a regional bank, we focus on our customers, not our
And we know that
stockholders.
you're going to stay with us for the rest of your life once we do
Yeah,
that with.
exactly. Man, that is phenomenal. I don't want to take up too much of your time because you are a busy man and you are selling a treasure. Not even selling, you're opening people's eyes to a treasure that they can take share in and make the pie bigger. For those, within banking that are listening, what's the best way to get a hold? Is it going to your website? Is it shooting you an email? How do you want them to reach out?
So first of all, you can put my email in the podcast. Happy to. You can go to our LinkedIn page. I'm very accessible. Our website, jonathan.a at takara-capital.com. Feel free to find me. I'm looking forward to getting those emails.
Yeah, I'm gonna be reaching out to people to tell them, go, don't be foolish. Reach out to Jonathan. What I know we talked about a lot, and I'm just goosebumps, man. I'm excited about this. I almost want to just go buy a bunch of properties so I can go sign up, or at least create my own mortgage bank just so I can partner with you and do this. What is anything maybe you want folks to know, or we haven't talked about, that you'd like to add?
So to me, again, I think from the borrower's perspective, the fact that you feel that you're locked in, it's not um, it's not it's not a truth that is here to stay. This will change, and that's what we're here to do. It is not the same elsewhere, and we can fix that. And for bankers, my message is there are a lot of or every single institution talks the innovation. Try to be the one who are walking the walk.
Yeah,
And if you ask me why this is not yet on the national news, that's the reason. It's because financial institutions, and especially after the great financial crisis and what happened with regulation that followed suit, and rightly so, they are extremely, extremely risk averse. They also have the too good to be true. And to me, the advice is they have to be open, listen, be critical, judge everything, check that all the I's are dotted and all the T's are crossed. But if it works out, give it a try. See if it works. And if it does, the path to scale is very, very short.
you're absolutely right. Just thinking about the not just the bank side of reaching out, but if there was a borrower out here, someone's in this situation, how could they find out maybe what banks you partner with today or who you're going to be partnering with in the future, that
Yeah.
they can maybe even call that bank and be like, I want that product.
So they can reach out to us as well. We have waiting lists, and we actually create groups of borrowers and send them to their banks. And we tell them this is the person in the bank that you should tell to call us. Or if you know the chief lending officer, connect us, and we'll get that going for you. But
Mhm.
yeah, you can reach out to us directly, and we'll help you find the right person within your lender to ask how you make that possible for yourself as well.
That's great. And now you're creating personal banking for people. I mean, Is there something you don't do, man? I mean, you're revolutionizing banking. You're creating I get to speak to someone who knows what it is about the product and I get to buy it, right? So if you're a consumer, you're selling your house, you're a realtor, call up, right? Just get connected with Takara and Jonathan and find this stuff out because you're going to pretty much find out you're going to be able to grow your business. You're going to be able to grow your personal capital and you're going to be able to grow relationship, you name it. This is phenomenal. I love it. Jonathan, thank you for coming on the show. I really appreciate it.
Thanks for having me, Ben. This was great, really. Thank you so much.
So you guys heard it here. I really urge you strongly to go and check this out, read about it. I hope this was helpful in terms of being understanding the mortgage market and how things work in housing, especially if you're a first time home buyer. This is something that why I'm surprised because I'm very understanding of it all. And you, if you've never done it before, you probably wouldn't get the same response. But I'm telling you, this is something you want to do. So make sure you get that knowledge, reach out, do your homework, find those banks, the banker, talk to him. Like this is going to revolutionize your businesses. It's going to help you with your cash flow, your balance sheets, your risks, all things that I know you're paying attention to, all you P&L owners, things that you need to focus on. So with that, I want you guys to keep on innovating and have a great week. Talk to you later.